Warren Buffett's company Berkshire Hathaway is now sitting on more cash than at any single moment in its history. $397.4 billion. That is more money parked in boring old government T-bills than Berkshire has invested in the entire stock market. So, if you've seen the headlines screaming about Buffett's terrifying market crash prediction, then you're in the right place, because his company has spent 14 straight quarters selling stocks and barely buying anything back. And here's why this should matter for your own portfolio. If the most patient investor who ever lived is refusing to touch this market, then that probably has implications for the index fund in your pension and the retirement account you've been faithfully feeding for years. So, what does Buffett see coming that the rest of us don't? You might think he foresees a market crash on the horizon, but he hasn't actually predicted one. No, the real story is far stranger, and it's hiding inside a set of documents most people never bother to read. So today, we break down the cash mountain that broke an all-time record, the filing by filing trail of exactly what Buffett has been dumping, and the twist nobody saw coming, where his own successor started betting the complete opposite way. My name is Guy, and this is the Finance Bureau. For decades, Berkshire Hathaway's entire identity was built on one principle: find wonderful businesses, buy them, and hold them effectively forever. Cash was the enemy, the embarrassing pile of money you hadn't found a use for yet. And for most of Berkshire's history, the value of its stock portfolio dwarfed whatever was sitting idle in the bank. But as of the 31st of March 2026, that relationship flipped for the first time ever. Berkshire's cash and treasury bills now sit at $397.4 billion, while the entire publicly traded stock portfolio is worth around $263.1 billion. And that pile of cash is larger than the entire annual economic output of South Africa and bigger than the combined cash holdings of Apple, Amazon, Alphabet, and Microsoft. And because it's mostly sitting in treasury bills yielding 4 to 5%, Berkshire is earning somewhere between $15 and $20 billion a year in completely risk-free income just by doing absolutely nothing. This is the largest corporate cash hoard in American business history, and it didn't appear by accident. It was built deliberately, one sale at a time. Which brings us to the paper trail, where we can see the actual evidence. Every quarter, large investors have to file a document with the SEC called a 13F. Think of it as a receipt, a public list of every stock the institution owned at the end of the quarter. And when you line up Berkshire's receipts side by side, you see something remarkable. For 14 consecutive quarters, stretching all the way back to late 2022, Buffett has been a net seller of stocks. Across that stretch, he offloaded roughly $195 billion more in stock than he bought, around $3.7 billion of net selling every single week for 3.5 years. And the flagship example of this is Apple. Consider that back in late 2023, Berkshire held around 915 million shares of Apple, a position worth over $150 billion at its peak. It was very nearly a one-stock portfolio, but then the selling began. By the middle of 2024, Buffett had cut the position roughly in half in a single quarter. By the end of 2025, the stake had been slashed by about 75%, down to just 228 million shares. That's nearly 690 million shares sold. And the reasoning he gave was telling. Part of it was tax, locking in gains before he expected corporate tax rates to climb. But part of it was pure valuation discipline, because Apple's price-to-earnings ratio had ballooned from around 12 to 16 when he bought it to roughly 33 by the time he started selling. In plain English, the stock had gotten expensive, so he took the money. But it wasn't just Apple. Buffett also cut Berkshire's Bank of America stake, a holding it had owned for over a decade, by roughly half, starting in mid-2024. Visa and MasterCard were dumped entirely, while around 77% of the Amazon stake was also liquidated. The pattern is impossible to miss. The smartest money in the room was heading for the door. And this begs the question of how ordinary investors are supposed to make sense of moves this large, made by people who never explain themselves until long after the fact. Well, that's exactly why you should be reading the Finance Bureau newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy so that you never miss what truly matters. All you have to do is click the link in the description or scan this QR code on your screen to get started. And now, back to the single biggest myth in this entire story, because here is where the crash prediction narrative completely falls apart. You see, Buffett never predicted a crash. Not once. If you actually read the transcript of Berkshire's annual meeting on the 2nd of May 2026, the language is far more interesting than a doomsday forecast. What Buffett actually said was that he's come to see the market as, quote, a church with a casino attached. And his point was that the casino has become vastly more attractive than at any other time in the past. He went further, saying, quote, we've never had people in a more gambling mood than now. He singled out people buying and selling one-day options and called it not investing, not even speculating, but, quote, gambling, just totally. Now, notice what's missing there. He offers no prediction, no specific date, and no exact percentage for a market drop. Rather, he's describing a shift in market psychology. And when that mild market wobble hit in early 2026, when the S&P fell around 11%, Buffett's response was almost dismissive. He looked at it and said, quote, this is nothing. That is not so much a man bracing for impact as one who simply doesn't think prices are interesting enough to bother. But this is where the famous Buffett indicator gets dragged into the conversation, so let's break it down. The indicator is simple, really. You take the total value of the US stock market and divide it by the size of the US economy. Buffett once called it probably the best single measure of where valuations stand at any given moment. Now, historically, a reading around 100% was considered roughly fair value, with readings below 80 to 90% associated with undervaluation and historically strong buying conditions. However, right now, depending on which methodology you use, the indicator sits somewhere between roughly 176% on a strict basis and over 227% on the broader measures. For context, at the absolute peak of the dot-com bubble in 2000, the indicator reached only around 140 to 160%, depending on the methodology used. So, on certain measures, this market is priced even more aggressively than the most famous bubble in living memory. But, and this is important, Buffett has cautioned against leaning on any single metric, even if it does have his name on it, because the indicator does have its flaws. It doesn't account for the fact that American companies now earn around 40% of their revenue overseas. It doesn't capture the value of intangible assets, and it ignores interest rates entirely. So, instead of a loud doomsday prediction, the reality is more subtle but arguably also more unsettling. Buffett and Berkshire Hathaway are looking at the most expensive market in a generation, full of people in what Buffett calls a gambling mood, and deciding the smartest possible move is to do nothing at all. His silence is the warning. But there's a twist to this tale because the moment Buffett stepped back, somebody else started spending. On the 31st of December 2025, Buffett officially handed over the role of CEO of Berkshire Hathaway, and the following day, his long-anointed successor, Greg Abel, took the wheel. At that May annual meeting, the symbolism was impossible to ignore. Buffett sat in the audience as chairman while Abel ran the show from the stage. And while everyone was busy reading Buffett's accumulated cash pile as a flashing red warning, Abel looked at the very same market and started buying the kinds of assets that cash pile supposedly warned against. Take Alphabet, the parent company of Google. Berkshire had only just dipped a toe in with a roughly $4.3 billion position late in 2025. Under Abel, however, that stake was more than tripled in a single quarter, ballooning to around $17 billion and making Alphabet a top 5 holding in Berkshire's portfolio. Then, in June 2026, came the move that really turned heads. Berkshire committed another $10 billion to Alphabet directly as an anchor investor in the company's enormous AI infrastructure fundraise. And here's the detail that should make every retail investor pay attention. That $10 billion went in at a negotiated discount to the prevailing market price on terms that were never fully disclosed to the public. This was Berkshire's first real move into the world of AI, structured almost exactly like Buffett's legendary 2008 rescue deals, where he handed over capital in a crisis in exchange for terms nobody else could get. Except this wasn't a crisis, and it wasn't Buffett. It was Abel, betting on the future on the most patient investors' terms. But Alphabet was just the start. Abel also re-entered the airline industry, taking a $2.65 billion stake in Delta Airlines. Now, that might sound minor until you remember the history. Buffett famously dumped every single airline stock back in 2020, calling the sector a bottomless pit and the investment a mistake. Reports suggest Buffett wasn't even consulted on the Delta decision, however. This was Abel breaking containment and striking out on his own. And then there's housing. In late May, Berkshire agreed to buy the home builder Taylor Morrison for $6.8 billion in cash, paying a 24% premium to do it. Abel's plan is to fold it together with Berkshire's existing Clayton Homes business into a single housing powerhouse, which is a far more hands-on, interventionist style than Buffett ever favored. So, here is the contradiction sitting at the very heart of this company. The same firm that spent 14 quarters building the largest cash hoard in history is now, under new leadership, deploying billions into AI, airlines, and housing. That said, though, Buffett does seem to have given his blessing, saying of Abel's home builder deal, quote, "He did it faster than I could have done it, smoother than I could have done it, and I never even talked to the CEO." And this is the exact moment these billionaire trades start directly impacting our money. Because the uncomfortable truth is, we can't copy these trades. When Abel put $10 billion into Alphabet, he got a discount that arrived via a private weekend phone call, the sort of call the rest of us will never be on. And if we try to follow that exact trade, we'd pay the full market price on the worst possible terms on every single one of those moves. And there's a deeper trap hiding in your retirement account. If you own a simple S&P 500 index fund, the thing most pensions are built on, you think you own a broad, safe basket of 500 companies. But Berkshire's own portfolio is now around 70% concentrated in just 7 stocks, and the broader market is in a similar place, with a handful of giant names driving almost everything. Your diversified fund is, in reality, a concentrated bet on exactly the kind of expensive market Buffett refuses to touch. So, when the most disciplined investor alive looks at your market and chooses to sit in cash, earning a safe 4 to 5% while warning that everyone else is in a gambling mood, that is a signal aimed directly at your portfolio. And there's one more layer to this cake, and that's the 13F filing, which is published 45 days after the quarter ends. By the time you've read about what Buffett or Abel did, the moment has already passed. When that Delta position was revealed, the stock jumped over 3% in after-hours trading almost instantly. The information reaches you last. So, the real lesson here is to study their discipline and to understand that the people with the most money and the best information are positioning for patience while the casino fills up around them. Buffett's silence might genuinely be the loudest warning of his entire career, or it might just be the last time anyone confuses simple caution for a crystal ball. But what do you think? Is the 95-year-old sage of Omaha right to sit on $397 billion and wait for the storm he can clearly feel coming? Or has Greg Abel read the exact same market correctly, and is the future of Berkshire one of buying and not waiting? Let me know your thoughts in the comments down below. And if you want to understand how the AI infrastructure boom that Abel just bet $10 billion on is reshaping the entire global market, then you can check out our full breakdown of that right over here. That's all from me for today though, so as always, thank you for watching, and I'll see you in the next one. This is Guy, signing off.